it dangerously expensive or secretly cheap? Welcome to Cheese Talk. No emotions, only structure, risk, and data. The market looks volatile, but something deeper is happening. Tech stocks are pulling back. High valuation software companies are getting sold off. This isn't panic, it's capital rotation. I'm breaking down three things: what's happening, where valuations stand, and what my actual game plan looks like. We're seeing a clear sector rotation within tech. Microsoft is down more than 30% from its peak. Nvidia has pulled back around 20%. Software names like CrowdStrike and Zscaler have fallen even further, and the IGV software ETF is down nearly 20% year to date. But this isn't a broad market collapse. Strength is simply shifting. AMD continues to outperform. Micron is up roughly 60% year to date, and SanDisk has emerged as one of the top performers in the S&P 500. This isn't liquidation, it's rotation. Capital isn't leaving the market, it's being reallocated. This isn't panic, it's repricing. Capital is rotating from stretched growth multiples into energy, materials, industrials, and staples. The market is broadening beyond just tech leadership. The S&P 500 trades around 6,900, with forward EPS estimates near $315, putting the forward PE around 21.9 times. The 10-year average is closer to 18.5x. Yes, we're above average, but the composition is different. The index is more tech-heavy, more growth-oriented, and higher multiples reflect that. In my view, fair value may sit around 20 to 21x. So we're not in extreme bubble territory, but we're not cheap either. And remember, rising price doesn't automatically mean expensive. If EPS growth outpaces price growth, valuation can compress. That's exactly what happened with Nvidia during its explosive run. In the current environment, my plan is simple. I allocate capital within reasonable valuation ranges and only buy high-quality businesses. I focus on three core drivers: revenue growth, margin expansion, and free cash flow strength. So how does that translate into action right now? Here are 5 names on my watch list. Let's start with Boeing. The stock recently pushed to new highs, and the 50-day moving average has crossed above both the 100-day and 150-day averages, a clear bullish crossover. I'm watching the 215 to 220 support zone to see whether price can hold and bounce from that area. The stock I'm most constructive on right now is Amazon. AWS and advertising continue to deliver high margin growth, yet the stock pulled back in the following session and is trading around the $200 level. I view this as a potentially attractive entry zone, especially with the RSI dipping below 30, suggesting short-term oversold conditions. Looking at McDonald's, the chart shows a wedge consolidation pattern. Price briefly broke above the upper boundary. I prefer to see confirmation before entering, as a failed breakout remains possible. If confirmed, the setup suggests room for further upside. Next is Capital One. The stock pulled back roughly 17% after earnings and is now consolidating near the 215 level. If it reclaims the 150-day moving average, I would consider building a position. Finally, Spotify. The stock had strong momentum earlier, but recently it appears to have fallen out of favor. As the chart shows, it has retraced nearly 50%, with RSI approaching 20, an extremely oversold reading. Structurally, however, its current development phase resembles the kind of base-building recovery we saw in Netflix during its earlier turnaround period. The goal isn't to bet on a single sector. It's to build a cross-cycle portfolio, different industries, different economic sensitivities, so you're not dependent on one narrative playing out. If you had to choose one of these names right now, which would it be, and what's your reasoning? Drop your logic in the comments.